Hello and welcome to another interview here on Citywire. Today I'm pleased to have the head of commodity strategy of Saxo Bank again on the show, Ole Hansen. Ole, it's great to have you back.
Thank you for inviting me back, Lucas.
Sure. Ole, our readers and viewers are very educated fund managers, so I think we can just jump right into the topic. I think what market participants worries a little bit are still the growth concerns. And we still see continue to trending down PMIs and other economic momentum measures. And I would like to know from you how this translates into the recent strength in the energy sector and some other parts of the commodity complex as well. And if you see some signs of that, how do you view the recent oil cuts that were announced from OPEC member states?
That's a big one. Let's start with the economic outlook. First of all, there's no doubt that we're seeing commodities been under somewhat some pressure here in recent months. Year on year, we are not showing. We drifted lower, and that is driven by the growth forecast. But I think it also, if you look at some of the individual commodities, which has actually held up quite well. You mentioned the oil market. It just highlights one critical issue for commodities that even though we may have a slowdown in demand, especially among the OECD countries, the supply side remains equally important when it comes to the pricing of commodities. And we've seen how oil prices are still trading in the mid-80s, even though we are concerned about a slowdown. That's obviously because supply is being kept tight by OPEC. In other sectors, we are seeing producers struggling to increase production, and that's also underpinning prices. So the outlook for growth is a worry, but at the same time, we have to consider the fact that the main engine behind the recovery in commodities at the start of the year, at least, was the reopening of China, and the reopening of China is still ongoing. It takes time for that to fully filter through to actual demand. Initially, they will bring down stock levels, but as the strength in the economy continues, then they will obviously have to go to the international markets to seek additional supplies. So I think that's probably why we haven't seen a strong impact yet on the demand. What it has done is kept the market from falling, because we're concerned about growth in Europe, in the US. We had the banking crisis triggering a massive change in the outlook for interest rates from further hikes to now pricing in more than 50 basis point cut in the US before year end. And that's the reason for that is clearly the worries that the data is showing a slowdown, but growth is primarily driven by Asian economies. It is China leading the way there. We're increasingly optimistic on the outlook for Japan as well, and then we have India, where growth is still very positive, and where growth is continuing. And these are really the engines behind the marginal increase in demand for commodities. So with that in mind, we're still constructive on the outlook for commodities as a whole. We see the energy obviously sector being supported by OPEC cutting supplies in order to maintain high prices for their most prized the asset. At the same time, we have the green transformation still underpinning prices for metals. We're seeing that in aluminium. We're seeing that in copper. And then on the agricultural, we're heading into a year where I'm sure there's going to be another round of uncertainties related to weather and so on. We're already seeing that in some corners where we got sugar prices trading at the highest level in more than 10 years. We have a resumed upward move in coffee. We have drought in Argentina hurting soybeans and corn production. We have drought in the US southern belts hurting the winter crop of wheat. And all these together with the ongoing war in Ukraine is still raising some concerns about supplies as we head into the planting and growing season. So all in all, the upside potential for commodity, and with that the commodity super cycle has been talked about. I don't think it's suddenly gone away. it has slowed, but the underlying reasons for commodity moving higher, i.e. tight supply at a time where demand is softening, but not I would say reversing, will continue to keep prices supported. It's getting a long answer because you also asked about OPEC, and the OPEC cut was I think really just a question of OPEC seeing what the rest of the world had been seeing in the previous months leading up to that surprise decision. We had the banking crisis both hurting banks and hurting the outlook for both Europe and the US. At the same time, we had yield curves indicating recession. We had this very big, sharp turnaround in interest rate projections. And OPEC is obviously part of the global economy. They're supplying a very, very key source of energy into the global engine. And as they saw that engine started to show signs of weakness, they responded, because the OPEC needs to optimize their revenues over the coming 5 to 10 years, because the demand of crude oil will eventually start to peak out and start to slow. And that basically means they are not prepared to accept lower prices for oil at this time, where they think also some of the selling was driven by speculative selling from CTAs, from hedge funds, basically triggering where sell buttons were triggered, or sell signals were triggered when we broke to the downside out of the range that had been established since November. That just automatically triggered selling activity without really asking any questions, and it was also attack on those short sellers that led to the decision, and we saw the result of that last week when the cut report, it actually came out on Friday, but I reported about it yesterday, and the rest of the market did as well. We saw a significant amount of buying of crude oil, both short covering and fresh longs coming into the market following that decision just before Easter. So is OPEC out? Is the game of OPEC to drive prices back to 100 plus? I don't think so, because they're not stupid either. They also know that getting oil prices back to that kind of level at a time where we are facing an economic slowdown, or the risk of an economic slowdown, or even perhaps a recession, that's not the best way to go forward. So I think what they ultimately want to achieve is a price that is not too hot, not too cold, and not too hot. It was too cold last month, and now it's still probably not too hot. It could perhaps reach the low 90s, but I don't think prices will go that much further at this point.
Yeah, that would be my follow-up question in terms of crude oil. If you expect the range-bound market or actually breakout to higher highs from here on, perhaps you can elaborate a little bit on where you see crude oil price developing, and also perhaps what do you think will be the driving factors or the story for the crude oil market in this year?
Well, you mentioned that your viewers are professional fund managers and hedge fund guys, and they also obviously watch the charts. And I think what's the biggest problem for oil right now is that we have a massive gap. Looking at the charts, down to 80 in Brent, down to around 76 in WTI, and these gaps are. I've been in this market for decades, unfortunately. You can see my gray hair, so getting on a bit. But I've seen a lot of these gaps, and they tend to be closed. But the duration of how long they can stay open obviously varies. But I think in the short term, that's still a bit of a drag on the market, that we have this big gap that potentially could be closed. And if that should be the case, if we start to see some weakness, then we have to remember that a lot of the buying that occurred last week basically occurred around these levels, because the market gapped higher. So a lot of buying, short covering and longs, were added on into the market around 80 and around 85 in WTI and Brent. And these will be exposed. I worked for a hedge fund in London for 8 years before I joined Saxo Bank 15 years ago, and I know the thinking, and I know the momentum nature of some of these positions. And again, if the price action is, even though the fundamental may be supportive, if the price action tells you the opposite, you need to adjust position. So I think we're still through that phase where it's the nervous stage, where fresh longs has come into the market, and they're still nervous because we haven't really seen any follow through buying to the upside. So with that in mind, I think there's still some short-term risk of a correction. But fundamentally, the OPEC has clearly shown the way. They are seeing less of a competition from US production, where growth is stalling. We're still seeing growth, but it is stalling compared to what the market had been looking for. they're all looking for, citing the increased cost of production, the credit crunch, which from the banking crisis last month may also have an impact on the investment appetite going forward, and that basically has left OPEC with a playing field a little bit, well, almost to themselves, and meaning that they feel in a much stronger position now to be able to manage prices than they had in the past. So they are, as I think as Citibank phrased recently, they have increasingly become the central bank of oil, basically trying to control the price level. And with that in mind, I think the downside below 80 now is very limited. To the upside, as I said, maybe into the low 90s. But overall, Lucas, I think it's still a market that looks like it wants to be range bound for the foreseeable future.
Because you mentioned the price action, we also saw after the gap up that crude tends to still trade in a narrow range. So definitely this gap is something to watch right now. As you said, you also mentioned the factor of weather before. Basically, since 2020, we saw 3 seasons of La Nina weather, which also supported a lot of grain prices in these years. For example, corn and wheat, we of course saw larger corrections in prices, wheat primarily driven through the Ukraine war. Now we have the first signs of this La Nina turning into El Nino throughout the end of this year or the end of summer. You have some thoughts about you view the weather developments?
Well, most certainly that is absolutely right that we have had a 3-year phenomenon with the La Nina, which has created some of these problems that we have seen, especially in South America, to a certain extent also North America, but also Asia. And with that turning into a La Nina, we had actually, I just saw a report that in that Pacific or the equatorial date line, a zero line, where these water temperatures are being measured, we actually had quite a bit of a spike in the zone 1 and 2. These are the areas just very close to South America, to Chile and Peru, and that was the biggest anomaly in a number of years. So it does really point to now the water, instead of having been cooler than normal for a number of years, is now turning warmer for a period of time, and that can have a significant impact, especially in Asia. So I'll be, and I think part of that story is already playing out, as I mentioned, in sugar, where some of the major exporters, India, Thailand, and Pakistan, they are seeing production starting to be impacted. Sugar is obviously also a case of increased demand for ethanol as gasoline prices remain elevated. But it could be a story for Asia in particular, but also it is having an impact with in the US and North and South America as well. So it just, I think all in all, what it just basically creates is more volatile weather, and with that also more volatile crop conditions, and with that also increased volatility across the agricultural prices. And we have seen the sector drift lower quite a bit in recent months, especially the grain sector has been under pressure, led by wheat. But right now, if you look at wheat prices in the US, Kansas wheat, which is the hard red winter variety primarily used for human consumption, the spread over Chicago wheat is now at a record level, simply because drought conditions in Kansas is ruining the crop. The crop condition is at the worst level on record. So these are all what we carry into the spring and carry into the next planting season. So I think we have to be aware that the volatility in crop prices and grain price and agricultural prices in general from these very big global weather phenomenon is going to stay with us, and the risk of El Nino is most certainly on the rise, as you mentioned.
Well, let's also jump into the precious metals sector, and we of course have touched on gold, which tends to be driven by real yields and also central bank liquidity. After the banking crisis, we saw an uptick in the liquidity measures because basically the central bank borrowed the bonds at par, and therefore we saw an uptick in liquidity. Where do you see precious metal sector developing from here on?
Well, I think it's at this point in time it's almost you always have to be a bit careful, but I think it's difficult to find any specific negative drivers for gold and silver in that case as well, because what we have witnessed so far this year is a market that has accelerated. We found support back in November last year, and we have to remember last year on paper was a very challenging year for gold because we saw a strong dollar, we saw real yields rally very strongly, and despite of these developments, gold still managed to trade close to unchanged on the year in dollars and up against other currencies, including the euro. And we've seen an extension now this year with gold trading at record prices levels against several currencies. I haven't checked the euro recently, but we most certainly had a record against the Australian dollar. The upside, some of the upside momentum that we were looking for, which we also made one of the reasons why we had this outrageous prediction about $3,000 gold this year. That's obviously not our official call, but some of the things that had to line up in a row for that to happen, I think, has been lining up. We are seeing the dollar starting to weaken. We're seeing this big drop in bond yields. If we now also eventually get that confirmed with a peak in Fed fund rates, then that could signal a period of additional strength. We've seen that during the past 20 years. The previous 3 peaks in Fed fund rates this past 20 years all led to were all followed by strong moves in gold in the months and quarters that followed. So that's also lining up. And I think what we realized and what we realized at the end of last year, being the reason why gold held up so incredibly well, because at certain times during